Well, he did it again. I mean, we thought, finally he's done for. He doesn't have the money to pay the bond for the civil fraud case. He's gonna have to sell stuff. Here we go. Just like all those other times. He'll never get elected after the grab him by the comment. He can't hire his kids into the administration, right? He's a Russian operative. Look at this guy. He's cozying up to North Korea. They're gonna get him on these impeachments. I think he's gonna die from COVID. He cheated on his pregnant wife with an adult film star and then paid her hush money from campaign funds. He's gotta burn for that. He tried overthrowing the government. There's no way they're gonna let him run again. Got elected anyway. There was no P-tape. Thumbed his nose at the emoluments clause. Hired his kids, hung out with Kim Jong-un, impeached but stayed in office twice. His lawyer went to jail for the hush money fiasco, but he didn't. Didn't die of COVID either. Still not in jail, still eligible to run, and now...
And it's an astonishing windfall for Donald Trump. His fortune just skyrocketed as Truth Social stock takes off.
Trading began for the Trump Media and Technology Group, parent to his Truth Social media platform. The firm ended the day at nearly $58 per share with a total valuation of $7.9 billion.
And they reduced the bond, so he'll likely be able to manage it without having to sell any assets. Want to know how he did it? UNFTR. Most people read the headlines and see that Donald Trump's company went public, thereby adding billions to his billions. The reality of the situation is both more complicated and actually simpler. It's simple in that the mechanism that Trump used to get his Truth Social company listed on the NASDAQ is the most straightforward way to do so. And I'll explain more on that in a bit. What's really complex is this mechanism has fallen out of favor with regulators and investors, and Trump's particular case is more of a shit show than these things are normally. Imagine that. So let's start with the basics, and then we'll get into the nitty-gritty of Trump's new company. The process of taking a company public is long, arduous, and very, very expensive. Most companies that go public are already very successful in seeking exponential growth by accessing capital in the public markets. And it typically takes years to build enough critical mass and consistent revenue growth, along with healthy profit margins, to get there. So assuming you have such a company, the regulatory gauntlet that you have to pass through is formidable. It requires multiple experts, underwriters, insurers, investment bankers, so many attorneys, all come together to create a package with an estimated value. Then the leaders or the owners of the company hit the road to raise money in an initial public offering from savvy inside investors that will get a premium on their initial investment when or if the company ever goes public. Everything and everyone is vetted along the way. Transparency is essential. Company performance over extended periods is critical. Seasoned executives with experience at the helm is a must. Early investors with a track record send important signals to Wall Street. Insurance companies back up the financial claims that are themselves backed up by external auditing firms. The SEC will conduct forensic audits and bury the management team with compliance requirements. Only then will the investment bankers attempt to place a value on the offering and test the waters in the market. The other type of company that follows this path is the unicorn. It could be hemorrhaging money month after month, but it's so special that it doesn't matter. Think Amazon. I mean, it took Jeff Bezos 9 years to turn a profit at Amazon, long after it had gone public. Same thing for Tesla, which had its first profitable quarter 10 years after its founding. High-growth companies like these usually have very deep-pocketed investors and are well-respected on Wall Street, and there's stories that are so unusual that they enter the public's imagination, like Amazon and Tesla, or FedEx and ESPN. And then there's Truth Social. Trump's social platform has been a disaster from the beginning. Now, first off, it's lousy tech. Second, it's bleeding cash, and there's no appreciable revenue model in sight. The last published financials on the company prior to going public showed that Truth Social managed to lose about $49 million through the first 9 months in 2023 on about $3.3 million in revenue. It's estimated that the platform has somewhere in the neighborhood of 5 million active users, which is a rounding error compared to the behemoth social platforms. And not to go all Hillary Clinton on you by calling the users deplorable, but when you consider the demographic information on those 5 million users, I'm guessing that it's not all that advertiser friendly. Don't be an elitist. That's why people hate progressives. You're right. My bad. Okay. The point here is that these kind of companies, these big social platforms, thrive on data mining and monetizing said data through advertising or with data brokers. And $5 million is nothing. I mean, Trump would be better off selling, I don't know, Bibles.
I'm proud to endorse and encourage you to get this Bible. We must make America pray again.
Oh, for f***'s sake. Anyway, Truth Social is no unicorn. There's nothing remarkable about it, and it literally has no upside. It will never, ever be profitable. I mean, its revenue is the size of an average independent pharmacy on your street corner. It has somewhere between 50 and 200 employees, though a lot of them are likely subcontractors as well. In other words, it's a scam. Now, to make matters more interesting, it went public inside of a shell company that also has no revenue, only a handful of employees, and no other purpose than to get Truth Social listed on a public exchange. So it's a scam within a scam promoted by the biggest scam artist on the planet. So Truth Social is the brand held within Trump's company called Trump Media and Technology, but we're going to just refer to it as Truth Social for the ease of things. Now, it merged with a company called Digital World, which now trades by the ticker symbol DJT, which stands for Dumb Jack Off Turd. Now, Digital World is no ordinary company. No, sir. It's what's known as a SPAC, a special purpose operating company. Now, these are publicly traded investment vehicles created for the sole purpose of acquiring or merging with an existing private company, effectively taking that company public without going through the traditional IPO process. Now, SPACs have been around for several decades, but they gained popularity in the early 2000s. They're referred to on Wall Street as blank check companies because it's essentially what they are: money in search of an idea. The first modern SPAC is widely considered to be the Jumbo Kingdom deal in 1997, where David Baker, a lawyer and investment banker, used a SPAC to acquire the Jumbo Floating Restaurant in Hong Kong. This success helped establish the SPAC model as a legitimate way to take companies public. But it was a tech bro named Chamath Palihapitiya who set the SPAC world ablaze. And thankfully, I don't have to continue butchering his last name because in the investment world, he's known simply as Chamath, like Madonna or Bono. Now, for a while, Chamath was the man. He came through Facebook, where many credited him as the agent of change in the halls of the social giant. And from there, he went on to become a glitzy Renaissance investor. When Chamath spoke, people listened. When he invested, they followed. And he made a fortune on Facebook and other companies like Tesla, and then seemingly he just couldn't miss. So when he announced that he was going big into the world of SPACs, game on. Chamath wrote out SPACs one after the other. He was so bold, he simply referred to them alphabetically, listing them as IPO A, IPO B, and so on. And the rush was on. Rates were dirt cheap, money was flowing from the government during the pandemic, and Chamath was shilling for SPACs like the ShamWow guy.
ShamWow.
And it wasn't just tech bros who were eating it up, it was all of Wall Street. What Chamath and others figured out was that high-profile people, from celebrities to Wall Street titans, could skip the hard part of going public and get listed with just a filing and a promise. Now, the idea people are called sponsors or promoters, and these promoters rally individual investors or institutional investors around a very loose concept, kind of a holding company in search of something to hold, if you will. Now, these initial investors come in at very favorable terms, typically with something called warrants, which allows them to purchase severely discounted shares of the SPAC once it's listed on the exchange. Now, the trick here, however, is all about timing. The SPAC usually has a limited amount of time, somewhere between 12 and 18 months, to identify an acquisition. And even the early investors are prohibited from cashing in their shares for a determined period of time to make sure that the SPAC is more than just a glorified pump and dump scheme. Now, these funds are held in a trust account until the SPAC identifies a target company to acquire. And once a target is identified, the SPAC undergoes a merger or an acquisition, effectively taking the target company public. Now, if the SPAC fails to complete the acquisition within a specified time frame, it has to return the funds to its investors. So the upside, in theory, is enormous. For investors, SPACs provide an opportunity to invest in early-stage companies with the potential for high returns, often without the same level of risk associated with traditional IPOs, in theory. For target companies, SPACs offer a faster and more predictable path to going public, as well as access to capital and experienced management teams. But despite their benefits, SPACs come with huge risks. Now, one major risk is that investors in the SPAC IPO may lose their entire investment if the acquiring company fails, and that's pretty standard, right? Additionally, the terms of the merger or the acquisition may be unfavorable to existing shareholders, leading to dilution of their ownership stake. Then there's the fact that regulators hate these vehicles. I mean, hate. Like every other public company, SPACs are subject to regulation by the Securities and Exchange Commission, the SEC, and other regulatory bodies like FINRA, similar to other publicly traded companies. However, there are some differences in the regulatory requirements for SPACs, especially regarding disclosure and reporting obligations. In each passing year, the SEC is making it more and more difficult for SPACs to maneuver because, well, they suck. For example, literally none of Chamath's SPACs ever worked out. In fact, they've been a disaster. And the ones that survived the holding period are down significantly. Others either closed or never even got off the ground, which has made Chamath somewhat of a pariah in investment circles. Now, for his part, he mostly blames high interest rates, but the fact of the matter is that most SPACs, even not his, right, simply didn't deliver on the promise because they skipped the line and they were all sizzle and no steak. Nice work if you can get it. That's how Morningstar VP of Research John Reckenthaler describes the SPAC gambit. Here's how he describes the funding scheme behind SPACs generally and how it applies to Trump's platform. Quote, "The ladder of SPAC investors contains 5 rungs, 4 of which are occupied by institutions. On the top are 1, the SPAC sponsor, and 2, the underwriter, which put up little money. Further down the ladder are 3, the investors who deliver the seed capital, and 4, pipe investors. Those 2 parties supply the merger's cash while receiving volume discounts. Finally comes the public, which buys its shares on the secondary market. It obtains no special favors. In other words, public shareholders pay a SPAC's way. It must be so. If each of the other 4 parties collect fees from the SPAC or receive discounted shares, then the 5th party must foot the bill. The math insists. That holds particularly true with Digital World for 2 reasons. 1, the company's pipe investors received unusually favorable terms. 2, its acquisition target is a shell that brings no assets to the bargain. Thus, public shareholders are twice diluted, once by the SPAC's insiders and then again by Trump Media and Technology's ownership stake." End quote. That even Trump would find an unusual way to go about an already unusual investment should come as no surprise. Once again, the chief grifter in charge had to pony up little, if anything, other than his name. In return, he receives extremely favorable terms on this investment of nothing. According to some analysts, just the cash portion of what he received once it went public was in the hundreds of millions, which would be enough to cover his bond in theory. But it's the valuation of the stock that everyone is really focused on. Now, before we get there, let me explain just how much of a grift this thing is, because as we know, Trump associates himself with only the best people. Now, to be clear, there is some big institutional money behind this. Susquehanna International, LPL Financial, and a host of other wealth management firms and family offices. But those are the so-called pipe investors that take the big risk for the warrants. It's the promoters, the guys that put the whole thing together in the first place, that are super interesting. Now, here are the names of the promoters that conceived of the Digital World SPAC: Patrick Orlando, Luis Orleans Braganza, Bruce Gerlich, Justin Shaner, Bruce Shevland, Eric Swider, and Lee Jacobson. It's less of a who's who and more of a who dat. So let's start with the original CEO, Patrick Orlando. Orlando was a little-known financier from Florida whose impressive resume included a defunct biofuel company in Peru, a deal with Venezuela to finance tugboats, and some other venture in China. The only real record of his accomplishments lay in the treasure trove of lawsuits he typically left in his wake, such as Benessere Capital Acquisition Corporation, remember that name. But he had enough to muster up a $25,000 investment into the Digital World SPAC, and he knew how to organize one. His stake now is purportedly worth around $600 million, even though he's already been ousted from the company. Then there's some sort of weird Brazilian connection. Luis Orleans Braganza was the founding CFO of the company. Now, Orleans Braganza refers to himself as Prince because of ties to Brazil's last emperor. A position, by the way, that he believes should be reestablished, and oh boy, does he know a guy that could fill it. Anyway, he was a vocal supporter of Donald Trump and maintains close ties with Jair Bolsonaro. Oh, he's also no longer with the company. Or Bruce Gerlich, formerly of Rocket One Capital and other financial startups, who was on the founding board. The SEC filed charges against Gerlich this week for trading in advance of the SPAC announcement through Rocket One. That's another fancy term for insider trading. Founding board member Justin Shaner was also associated with defunct and troubled Benessere Capital, which was subpoenaed by the SEC last year. Brian Shevland of Bluestone Capital Management, also a founding board member of Digital World, was suspended by the SEC from acting as a broker. Eric Swider was also a Benessere guy, and Lee Jacobson was involved in multiple failed ventures, including AppMetrics Analytics, which was liquidated in Chapter 7 proceedings in 2019. Like the man said, only the best people. What happens next is what always happens next. The first part of what happens next is a guess. The second part you can bank on. So the first part is that I'm guessing the Trump-controlled board offers him special dispensation and removes the prohibition of selling stock before the 6-month mark. Now, I don't think it'll happen immediately, but I think it will happen in short order as his trials heat up. The second part is way more bankable. At some point, Digital World, ticker DJT, owner of Truth Social, has to actually perform. The people who put this thing together originally have all made a killing. The investors, even the institutional ones, however, are in a position of tremendous risk right now. Unless Digital World has some other acquisition up its sleeve, like a real one, then this one is fucked. This is GameStop, a pure pump and dump scheme, except it's not gamer and crypto bros fucking with the system. It's real investors and real companies pouring money into a publicly listed company that has a valuation of around $8 billion today. For a holding company with an asset that generates about $4 million in revenue and over $50 million in losses. Never, and I mean never, in the history of investing has math made less sense. But you know this much. Donald Trump won't get hurt, can't get hurt. He's already won because of the upfront fees he participated in. And if the board grants him the ability to liquidate shares in the coming weeks, then he'll have literally pulled off the con of the century, maybe longer. So I guess what amazes me is that no matter how many times or how many ways he fucks people over, there will always be those that go, this is the time that he goes down. And then there will be the people who just give him a pass. And others who just applaud him for it. It's like that moment in the debate with Hillary Clinton when he was accused of dodging taxes, and he didn't refute it. He leaned into it and said, that's what makes me smart. Then he went to Michigan and told auto workers that, yeah, I might hate unions, but I hate management more. And they loved it. And when this thing goes belly up, he'll shit talk the investment banks and the Wall Street types and tell his followers that they deserved it. And they'll cheer and they'll laugh. And they'll buy the merchandise and maybe even a Trump Bible. And most importantly, they'll vote for him. After this latest move, it's official. He is the greatest con man who ever lived. Here endeth the lesson. Named Chamath Palihapitiya. Fuck my ass. Palihapitiya. Fuck me. Palihapitiya. Palihapitiya.
Sham wow.